Welcome to Markets Now. I'm Michelle Rook with Kevin Good with Cattle Facts. And Kevin, we're coming into 2025. We've already hit some record high prices. Are we going to continue to see record-setting prices for 2025? What is the outlook from Cattle Facts first on the calf side?
It is. If we think about it, we'll just start out. Production will more than likely be lower this year as far as beef supplies. We've got it down 2%. We also would suggest in the harvest level, we'll have another 350,000 reduction in cow slaughter and about 700,000 head reduction in fed slaughter. So that's a million head less. So if you think about supply, will be constructive, will be positive. But on top of that, we had record beef demand last year. We think that will continue. We think that we'll continue to have very strong leverage for the cattle producers. We think about the amount of cattle going through the system and more shackle space being built this year. So that's all going to translate into more dollars available. We would have the calf market this year averaging closer to 330 to 340 on a steer calf. That contrasts to 310 last year. If we went to a yearling 7.5 weight steer U.S. average, we would put that at about 270 this year versus about 248 last year. And take that to the fed value. This year we would suggest about a 198 average compared to 186 average last year.
So is that translating into profitability for producers? Because I hear of some pretty high break-evens right now.
It has been. We've had a very good run in pretty much every segment. As you suggest, though, is what we're paying for yearlings and calves. Thinking about the feedlot sector, they're buying break-evens today on top of $2. And yeah, we've sold fed cattle over the last 2 or 3 weeks above 2, but that's the first time in history. So are we betting on the come to some degree? Yes, we are. But that's the stage of the cycle that we're in. We'll continue to see more of those dollars trickle down to the yearling operator and to the cow-calf operator. So cow-calf producer is in a profitable position, assuming they've got adequate feed resources, and that's been a challenge for the last 4 years, and that's one of the reasons this cattle cycle has lasted longer on the liquidation side because of the lack of moisture.
Yeah, and right now, when we look at things that are limiting us rebuilding this herd, that's part of the equation, but it's only one part, right?
It is. It's probably the biggest if we think about weather patterns. But on top of that, I think you could list age of producer. Average producer is getting a little bit long in the tooth. We think about availability of credit and also the cost of credit as we think about interest rates. Think about urban sprawl, alternative land usage. There's a lot of headwinds as far as expanding. So because of that, the calf market, it already has, but it's probably going to continue to get a lot higher than a lot of folks thought, just to incentivize folks to come back and start to expand.
Kevin, do you feel like producers are healing? We had some tough times before we got into this bull cycle.
Absolutely. I think people are getting a little bit more flush, particularly the cow-calf operator. Again, the real bottom line there is where they're located from a moisture standpoint, because we continue, even though moisture conditions last year were better than the 3 previous years, by no means are they great. And the weather forecaster will suggest we're still in the La Nina pattern, which is a little bit drier pattern as we go through 25. So that's still going to be a pretty major headwind.
Right. So you mentioned that producers are profitable right now. We talked about the fact that we have a tight supply, but how much are the weights, the heavier weights, making up and creating some virtual cattle for this cycle?
That's a very good question. If you just looked at last year, and last year we had a record 1-year increase. It was 26 pounds in 1 year. That offset basically a million head of harvest cattle. So last year's a very good example because we harvested a million less cows, about the same amount of fed cattle, and the carcass weights offset that. So production last year was basically even in 24 compared to 23. All the difference of the increase in weights offset 1 million head of cattle.
Do you see inventory continuing to slide, though? The cattle inventory report would certainly suggest that, right? That we're not into the tightest numbers yet?
It would suggest that we're probably at the bottom end of the trough as far as beef cow numbers are concerned. We think we're there. Cow slaughter last year was at a point where we were starting to rebuild the beef cow herd at the end of last year. But heifer retention, we're not seeing that yet. We're starting to see plateau, so it would suggest that your beef cow herd's the bottom end of the cycle, which would still suggest your tightest supplies, once you start to keep heifers back, are still more than likely 2 years in front of us at the earliest.
No doubt. So that's going to keep things very tight for a while. Heifer retention, what will finally trigger producers to start retaining? females?
Frankly, I think we've got to have a lot better moisture conditions. That's the nut on the top of the list. And also, if we think about our producers, they've had a good go the last year or two. After a series of years they build confidence of higher prices, and they'll start to retain some heifers. We're starting to see a tick of it. You know, we're keeping a few more heifers back than we did 2 and 3 years ago, but we still have an elevated heifer population on feed that would suggest that at best we're maintaining our herd on the heifer side. Again, cow slaughter suggests we're starting to expand a little bit, but we're offsetting that. We're not keeping the heifers back yet. So really the message is a flatter herd as we go through 25.
And you mentioned demand being robust. We haven't seen sticker shock yet from the consumer.
Yeah.
Have you been surprised with that?
We've been very surprised, particularly in the wake of record supplies of pork and poultry at much softer prices than beef. So that price spread continues to widen between us and our competition. Very good sign for us. But at the same time, at some point, we would suggest that retailers are going to have to go ahead and push prices substantially higher to limit demand for the tighter supplies we envision over the next 2 to 3 years.
What about packer margins? How far in the red are they?
They're tight. You know, you can do the calculation, maybe say they're even to 50 below on average. This phase of the cycle, they'll be break even at best, not only this year, but probably for the next couple of years. If we think about it, last year, 1 million head less going through the system. This year, 1 million less going through the system. At the same time, we're going to build capacity, 2 new plants going on board this spring. So the leverage component will continue to favor the cattle producer over the next couple of years. Margins will be snug for the producer or for the processor.
But we have a few new plants that are coming online.
That's true, 2 this year, and a couple other spots where you're getting a little bit of extra capacity with new kill floors and improvements in the existing plants.
One final comment, how important is risk management going to be as we have these, high prices and we have to protect that?
Absolutely. So you think about record high values and a lot of volatility. And let's remember, we live in a dangerous world out there today. Black swans, we haven't had one recently, but obviously with some of the tariff talk, some of those things, we could have a number of things that create volatility. Risk management is going to be extremely important. As more dollars are exposed, particularly in this phase of the cycle, there will be a peak. Now, it might not be this year, might be next year, year after, but there will be a peak. Once we hit the peak, it will come down. So at that point in time, risk management is going to be very important.
Well, this has already been a different cycle than 14-15, where we did have that blow off top and prices crashed really quickly. Will this one be a little slower, do you think?
In theory, it should be. A couple of reasons. One, the supply side. Last time it was a V bottom. We expanded very quickly, kept a lot of heifers back, and so we got back into bigger supplies much quicker. We don't envision that. We think supplies, it's more of a U bottom, so it takes longer to build our supply side back up. The other component is leverage. At that point in time, we were going through a process of shutting packing plants down. We're doing the opposite. We're adding capacity, so that leverage component should continue to favor the cattle producer for longer. So yes, once you go to the top, you have to go down, but we would envision the decline to be much slower this time around.
And we do have the border now open to Mexican feeder cattle. How many are coming across, and how's that process working?
It's going to be slow. They're testing as we go through this into this week. They're testing it. In theory, if you look at it in the rearview mirror that's been closed for 2+ months, there'll be less cattle coming across. If we just looked at 24 and this year, you combine the 2 years, because being shut down for 2 to 3 months, they won't be able to make up the difference. So more than likely we'll have a couple 100,000 less coming across than we would have otherwise. So that in itself helps to the supply side through this year.
Okay. We appreciate your time as always and your outlook.
Thank you.
You bet. Kevin Good joining us with Cattle Facts here from CattleCon 2025. This is Markets Now.